Hey everyone, in this video I will be telling you about the three stocks that I have already invested in and will be looking to invest even more this month. Now, the first stock is Meta. I've got to say, one of the biggest reasons I'm eyeing Meta as a top pick right now is their ridiculous ability to keep the advertising cash rolling in. Ad revenue alone hit 46 billion in Q4, which made up a solid 97% of their total revenue. That's really insane when you think about it because most companies would kill for a fraction of that. And yet Meta keeps scaling. They're not just milking existing advertisers either. Get this, pricing power went up by 14% on average, which basically says advertisers are willing to pay more because they're actually seeing results. Their AI game is also a big plus, right? We're talking about over 60 billion thrown at building AI infrastructure, pumping out Llama 4, which is their next gen model, and rolling out custom chips because apparently they don't want to rely on Nvidia forever. That's some serious forward thinking. Instead of being stuck as just the Facebook company, Meta's leaning into the future of tech. Now, AI is kind of the thread tying everything together, right? If you can keep improving ad targeting in a world with privacy crackdowns, you stay one step ahead of the game. And it's not just the existing social apps that make them interesting. WhatsApp is racking up 100 million US users, which is huge if you consider how slow the US adoption was at first. And the business side of WhatsApp is pulling in more revenue than people ever expected. Then you've got Threads at 320 million monthly active users. That's not a tiny number by any means, and it's still relatively new. It's like having multiple engines on a jet. If one slows down, another picks up the slack. And the best part is that all these apps feed into the same massive ad ecosystem. Now, another angle I like is that Meta's taking swings at new form factors like the Ray-Ban AI glasses, right? Are they just going to replace your phone tomorrow? Probably not. But the fact they're already seeing decent adoption should make you raise an eyebrow. Maybe in a couple years, these AI wearables become the next big shift in consumer tech, similar to how smartphones took over, right? If Meta is at the forefront of that shift, it's a whole new revenue stream we're not even accounting for right now. That's the kind of forward-looking bet that can pay off in a massive way later. Of course, there's Reality Labs, which is pretty much our giant money sink at the moment. 5 billion lost in Q4, 17.7 billion lost across 2024. But when you're generating so much cash from ads, you can afford to take big moonshot bets, right? Think of Reality Labs as a venture into the metaverse that might come in handy if VR or AR suddenly pops into the mainstream in a serious way. So if it doesn't, well, Meta still has the unstoppable ad machine and a growing AI empire to fall back on. Now, the numbers backing all this up are no joke either, right? 164.5 billion in annual revenue for 2024, a 42% operating margin, over 91 billion in operating cash flow. These are the kinds of stats that let you sleep at night if you're an investor. They're also returning 29.7 billion to shareholders via buybacks and dividends. So it's not like they're just hoarding the wealth for themselves. And with a PE ratio in the high 20s, it's not exactly cheap, but it's far from overpriced for a company growing at this pace, right? So plenty of folks see it marching towards higher valuations as these AI initiatives start bearing fruit. Even regulatory hurdles haven't slowed them much, right? Apple's ATT changes, Google's future cookie phase out, GDPR fines. Meta just shrugs them off, adapts, and keeps making money. Not to mention their custom AI solutions might help them rely less on external data, making them more resilient to privacy clampdowns, right? Put it all together, and you've got a company with a multiple growing platforms, massive AI investments that enhance their core moneymaker, which is advertising, and the financial muscle to fund a branch of crazy projects without going under. Meta isn't just Facebook anymore. It's a diversified tech giant still hungry for more. In my book, that's a recipe for staying on top for years to come. So the second stock is TSMC, Taiwan Semiconductor Manufacturing Company. It stands out as one of my top picks right now, and I'll be investing more. Why? Well, first off, TSMC is basically the go-to foundry for advanced chips. Think AI accelerators, high performance computing, and the most cutting edge smartphones. If you're at all excited about the future of AI, this is exactly what you want to hear. TSMC holds the keys to the kingdom when it comes to manufacturing the brains of every major AI project out there. whether it's for NVIDIA's GPUs, Apple's latest chips, or AMD's newest processors. To be honest, the recent dip in its share price was, in my view, a knee-jerk reaction to concerns that a new Chinese AI model, DeepSeek, might reduce demand for high-end semiconductor hardware somehow. But if you think about it, more efficient AI software generally leads to higher overall usage, which ends up creating more demand for advanced chips. Cheaper AI doesn't kill hardware sales, it often stimulates them. This is why I'm still confidently bullish on TSMC. It's basically the one-stop shop for leading-edge chips, and if AI keeps growing, which I'm pretty sure it will, that spells a whole lot of manufacturing demand heading TMC's way. Now let's talk numbers, right? TSMC has been racking up impressive year-over-year revenue growth, sometimes pushing into the high 30% range while consistently delivering gross margins that hover around a jaw-dropping 59%. Most manufacturers can only dream of margins like that, so you really can't complain, especially as they ramp up to meet AI needs. They're also keeping guidance strong, projecting double-digit revenue growth this year and next. Their capital expenditures might seem huge at nearly 40 billion or more, but that's how TSMC stays on top. They're pouring money into new fabs, advanced node development, and cutting-edge packaging. This is the kind of big spending that can scare off weaker players, but TSMC has the cash and the customer base to make it worthwhile. Plus, if you're looking at the competitive landscape, Intel is still behind on manufacturing technology. Samsung has cut its spending plans, and no one else remotely close to matching TSMC's process leadership in 3nm, 2nm, or whatever advanced node is next. That near monopoly on leading-edge chip fabrication places TSMC in an amazing position. As AI workloads explode, from massive cloud data centers to next-generation consumer devices, TSMC essentially becomes the toll booth everyone has to pay. Meanwhile, the stock's valuation isn't over the top. Is this trading around 19x, 21x forward earnings? Much cheaper than some other high-flying AI plays with bloated multiples. Factor in that TSMC is likely to deliver more than 20 to 30% growth in the near term. And you're looking at a price-to-earnings ratio that's well under 1. In other words, you're not paying a premium for something that's obviously critical to the AI boom. That's exactly the kind of setup that gets me excited. Of course, people point to geopolitical risks around Taiwan, but honestly, TSMC's expansion in the US and Japan, along with the world's reliance on its chips, makes an outright disruption less likely in the near term. In any crazy scenario, it wouldn't just be TSMC that suffers. It would be an entire global tech supply chain. So it's not TSMC specific landmine. It's more of a macro concern everyone faces. All things considered, TSMC delivers unstoppable AI-driven growth, high margins, massive R&D investment, and a valuation that still seems reasonable given the current market. If you ask me, that combination checks all the boxes. And it's precisely why I'm putting TSMC at the top of my semiconductor list and the second best stock of the month for myself. Now, the third stock is Alibaba. Alibaba is easily one of my favorite picks right now, mostly because it feels like you're getting two winning businesses in one, right? First, you've got their core e-commerce platform, Taobao, Tmall, and so on, which still hold a massive share of China's online shopping market. Yeah, their piece of the pie might have shrunk a little in recent years, but they're still the top dog in a country which over 1 billion people love to shop online. Plus, every time there's a big shopping holiday like Double 11, they rake in absurd amounts of cash, which is exactly what you want to hear if you're looking for revenue growth. What really puts Alibaba on another level is its cloud computing arm. People often treat it like a side hustle, but I think it's going to be their main stage act down the road. They're projecting double-digit growth, something like 11% CAGR in Alibaba Cloud through 2027, largely because all kinds of big industries, finance, healthcare, manufacturing, are finally seeing the upside of moving everything to the cloud. Throw artificial intelligence into the mix, and it's a recipe for serious revenue acceleration. The best part is that Alibaba has its own AI models, like the Qwen 2.5 Max and the Qwen 2.5 BL, that already have beaten a few high-profile competitors in benchmark tests. Now, if you believe the future is AI-driven, and I sure do, then Alibaba Cloud is nicely positioned to collect all those sweet subscription fees. And another thing I love is Alibaba's ability to expand globally while also returning real money to investors. They've got international e-commerce brands such as AliExpress, Lazada, and Trendyol growing at 20% or more year over year. Management is so confident about the momentum that they're calling for profitability in a year or two. If that doesn't excite you, consider this. They're also returning loads of cash to shareholders, over 100% of their free cash flow in the form of buybacks and dividends. In the last 12 months, they've already shelled out 23 billion in buybacks and 6 billion in dividends. And those numbers are projected to be just as solid in the coming years. If you're looking for a combo of growth and direct cash returns, you can't really complain, can you? Now, you might be wondering about all those whispers of Trump 2.0 tariffs and whether they'll drag Alibaba down. To be honest, it looks like they'll have only a minor impact this time around, especially compared to the large-scale trade tensions we saw a few years back. Most of Alibaba's big moves are in sectors like cloud and AI, and a narrower set of tariffs on certain goods isn't likely to disrupt that much. Now, Chinese exports to the US have already been in flux, but Alibaba is also making money in Southeast Asia, Europe, and beyond, so there's a decent cushion if one region faces headwinds. Best of all, the best of all is Alibaba isn't priced like other hot growth stocks. It's trading at a pretty modest multiple, somewhere around 9x, 10x forward earnings when I made this video, while aiming for 8 to 10% revenue growth and 13 to 15% earnings growth in the next couple of years. That's a value proposition you don't see every day, especially for a global leader in e-commerce, AI, and cloud computing. So if you ask me, it's only a matter of time before more investors realize this and start bidding the stock back up. Add all that together, and it's hard not to see Alibaba as a top-tier pick. You've got strong e-commerce fundamentals, a rapidly growing cloud unit powered by legitimate AI breakthroughs, and a shareholder returns program that hands out buybacks and dividends like candy. Mix in the fact the new round of tariffs probably won't derail them, and I think it's a slam dunk for anyone who wants exposure to China's economic rebound plus the hottest AI trends rolling out right now. That's it, guys. If you enjoyed the video, please hit that like button.